Welcome to the Concierge CPA. I'm Jackie Meyer, founder of TaxPlanIQ software. This is a podcast for accounting firm owners and influencers who are pursuing world-class service. Let's go, y'all. Hey there, I'm Dr. Jackie Meyer, CPA, and welcome to the Concierge CPA podcast. Before we dive in, here's something exciting. TaxPlanIQ users are saving their clients an average of $40,000 in taxes per taxpayer while selling large tax plans. TaxPlanIQ is the ultimate resource for tax advisors. With nearly 500 firms on board, we're helping advisors build skills, grow confidence, and connect with a vibrant community. Want to learn more? Visit taxplaniq.com/podcast for exclusive discounts, resources, and other things mentioned in this episode. Now, let's jump in. Today, we're diving into a strategy that most accountants and financial professionals have never heard of. I learned of it several years ago randomly from a mentor that was like this amazing tax planner. And he kind of whispered to me across a lunch table at a conference, have you heard of the 401h strategy? And what's so cool is that it quietly unlocks tax savings, health benefits, and retirement power in a way that traditional plans cannot touch. And it is definitely one of the most underutilized tools in the entire tax planning world. So I have someone that is the best explainer of this strategy that I've ever heard. David Podell is joining us yet again, the founder of Business Benefits Consultants and a national expert in advanced retirement design. So he teaches accountants how to move beyond basic planning, help clients extract profits in tax-favored ways. And his work around the solo 401h has created so many opportunities. We just had him on our TaxPlanIQ Summit, which had almost 2,000 people. And he said his phone was ringing off the hooks after that for people that were really interested in learning more. So welcome, David. We're glad to have you back.
Thanks, Jackie. I think this might be the third or fourth one.
Yeah, I like deleted the line where I was going to say the number you've been on the show.
Yeah.
I don't know the answer to that, but you're probably my most frequent guest.
Oh, that's impressive. So I feel good about that.
Yeah, but every time we bring something new to the table, right? So this time we get to focus on why do you think that the solo 401 or 401h in general is still unknown to most advisors?
Yeah, it's interesting. There's so many TPAs and actuaries out there, and we use all these different designs, and some do it and many do not. And again, anything, as you know, that adds a level of complexity, a lot of times just doesn't get done because everyone wants simple and easy. But that doesn't mean that the benefits are as good as they are. So sometimes we have to go complex. I know you have strategies you work with, like when you talk about captive, for example, that's complex. There's so much involved with it, but those benefits are massive. So same kind of thing when it comes to strategies like this. I think that the reason it's not getting used as much is because there's just not, first of all, in general, it's added to some type of retirement plan, and that has to be either cash balance, defined benefit, money purchase. So it has to kind of piggyback into that design. And there's only that sample of people that understand or getting involved in those plans. And to your summit and to everything I speak about, you know, your whole ecosystem is built on advisory and moving toward an advisory level, billing in a proper way, ROI, and these types of strategies fit in doing that. And if you're taking that sample and you're involved in TaxPlanIQ, then you're really looking for those types of strategies that are out there. The good thing is you provide experts on your platform like us that people can talk to say, okay, it's implementation time, or let's take a look at a proposal, take that second step, rather than just putting it into the software and saying you could save the clients all this money. Now it's taking the next step and seeing what does implementation look like and having someone customize that plan for you.
Yeah, for sure. Now, several years ago, after I first learned about the strategy, I kind of described it like a layered cake. I think I ended up writing a Forbes article about it. I'll have to go back and find it. But because you do have to have that base defined benefit plan, so to speak, right? And then this is like icing on the cake because not only did that defined benefit plan already let you pump hundreds of thousands that's deductible each year into retirement when a 401k and the other retirement plan options are capped around like 70K total employer and employee right now. The 401h is a special little soul because it's embedded in your retirement plan as like a HRA or HSA on steroids, right? And you always hear me say the defined benefit plan is like a 401k on steroids, but I mean that's really what the 401h does for us. So tell us like in a very simple way, what is a 401h?
So this is a component of let's say a cash balance or DB or money purchase. It is a component of it that allows generally for a third of those dollars to go into a bucket that is, and these assets are pooled, but that portion that's getting designated is like your HSA on steroids rather than your pension on steroids, your HSA. So, um, if you think about an HSA where you have limits that are, I don't know what the exact one is right now, but it's
Like
10, 10.
8,500, I think, for
Yeah,
married.
I was gonna say 8 to 15 or so. None of that move. That yes, we talk about that. There's a tax benefit to doing it. It is a good thing. Does it move the needle if you owe $300,000 in taxes or 5 million in taxes? Not at all.
No.
When you go and put this inside of your pension plan, what you're doing is you're allowing for future health benefits to get paid tax free. And you could have hundreds and hundreds of thousands of dollars inside of that 401h portion. Now, that gives one huge, massive benefit, which is triple tax free. No taxes
Hmm.
going in, no taxes on deferral, totally tax free coming out if used for medical expenses. So that's the first and biggest benefit. We often see designs where we can get more money sometimes in a plan because they have that 401h benefit in there. I would say one of the most important, but I haven't mentioned yet, benefits is vesting.
Mm,
Employees that you have do not vest unless they retire with you. So they might be getting allocations along the way, but in small business, medium-sized business, how many employees go from beginning to end and fully vest into this? So what it does is it helps efficiency. When I
mhm.
talk about efficiency, I'm referring to how much can we get to an owner. And all these plans, so these large deductible plans, it's always about the owner, the biggest taxpayer or partners. So
Sure.
we're looking to get in every plan that we do anywhere between 85 and 95% to owners. And I would say the average is generally 90% and above. But in those cases, you're able to get more to owners because you have a portion of these dollars going to employees that are never going to invest. Sorry,
Mhm.
vest, not invest. Vest.
Right.
Um, that helps on testing and everything else. So those benefits are huge alone for to often be looked at. The other thing too is we've seen this a lot just in practicality. A lot of times people don't use that 401h. They close their plan. They want to move all the money to the IRA, which that's what happens. These plans close, small business, they're not kept open, they get moved to an IRA.
Mhm.
If you want to utilize that 401h or continue with it, that portion that's designated stays in the plan, and as a solo or the plan alone just files a simple 5500 every year and keeps those assets in there. They grow, and then when funds get taken out to be used for retirement benefits, just like an HSA, they can be used for anything that's on that list, and that list is huge. It doesn't have to be just, well, my insurance expenses or medical
Yeah.
benefits that I have. It can be those gym memberships, plastic surgery, massages. It goes on and
Yeah,
on.
that's what I wanted to make sure and state because I think I don't remember, I think it's the most liberal of all the plans for one reason or another. So there's like over 100 things that can be included, including, yes, elective cosmetic surgery, spa, massages, fitness programs, LASIK eye surgery, eyeglass frames, insurance and insurance deductibles.
Mhm.
And you tell me because the last stat I heard is probably low because of all the inflation we've gone through, but like the typical retiree is spending half a mil or more towards health expenses. Is that true?
Yeah, it's the biggest expense in retirement. Whether you have money or you don't, you have medical expenses in retirement. There's that level playing field where you're paying for it some way or another, and
Hmm.
having an account and the ability to use to do those things is really beneficial if you do it. So from an efficiency standpoint, the owner is generally getting more by using that benefit inside of the plan.
Hmm.
It's becoming more efficient because you have the vesting schedule where these employees basically have to retire with you. And if they
Hmm.
don't and they get a 401h benefit, great, but it's generally winds up in the owner's hands.
Yeah. So let's do a case study because I like real math, right? So let's say that an owner is able to put half a mil over, several years into the 401h plan. They retire, they start receiving their benefits. So let's say their defined benefit plan in general has like a mill in it, which was tax deferred, but they do have to pay tax when they distribute out the defined benefit plan, except for this portion. That's what's so crazy and amazing about this, right? So 500K becomes shielded from tax permanently, and let's say someone's in the top personal rate and let alone don't never count state, which can take you up to like 50% tax rate. We're looking at just under like 200K worth of tax savings on that 500,000 um that you put in the 401h, right?
Yeah, and not only that, it's on money that you were going to use and spend anyway in retirement.
Exactly.
You have these expenses. They don't go away. They're there. It's just always going to be there, and this allows you to go and fund that way. Um,
Mhm.
we've seen people do it, and I'm not recommending this, but they'll do it and say, "Hey, no, that's my long-term care bucket. I don't want to go and give risk to an
Mm.
insurance company."
Yeah.
So it's giving peace of mind. But yes, it's taking also money out of the business on a pre-tax basis, putting it away, and then not paying taxes on it ever again. If you decide, hey, I'm not going to use all this, or I don't want to, or something to that realm, it could just go and get moved into the rest of the bucket. There are
Mhm.
ways to then combine it in a way where it becomes as long as and it gets a little complicated because it is all pooled money and it's just designated inside the plan of what's going in there. So sometimes we don't want to have too much, but there are ways to just make it, hey, move it all to my IRA and I'm just going to go pay taxes on it. And that's great. I got a bigger deduction or I got more to myself, but I'm going to go pay taxes on this. And now it gets lumped into the other funds um,
Mhm.
to get used in retirement and taken incrementally and taxes paid on it or whatever.
Hey, it's Dr. Jackie. Are you enjoying today's episode? If you are, here's how you can support the podcast. Like, share, and subscribe to the Concierge CPA podcast to help us reach even more listeners. Continue the discussion and connect with other accounting professionals in the Accounting Firm Influencers Facebook group or follow me on LinkedIn. Thanks for listening, and now let's get back to the show. Yeah, so you said something really important that I want to stress, which is the fact that This is literally kind of a back of the napkin calculation that the employer is keeping track of each year. I mean, obviously, they're using you to help them figure out the numbers and amounts, but they have to record it on their balance sheet or show like what's being set aside for this fund so that it's tracked appropriately. So just, make sure as a listener, if you're going to implement this, this does require a little extra handholding and concierge level of service to go long term with that taxpayer to make sure that they're maximizing the benefit over the next decade plus, right?
So it's not the employer that has to track it, it's the actuaries. So it's internally in the document anyway, and it's being done on a valuation that's getting done every year anyway. So it's
Okay.
in the document, there's the valuation in there. And
Mhm.
yes, it all has to be tracked and done the right way. And sometimes people even want to have someone look at like what comes out and the reimbursement and all that. I haven't seen any situations where it's gotten like tested, looked at, or any of that, what you're distributing and not paying taxes on. But
Yeah.
it's a benefit that's been around a very long time. It's sometimes we've seen it in very large companies too, where they have it kind of hidden in the document, but it's in there as a benefit
Mhm.
for executives that are maybe getting retiree benefits. But it is that health benefit that's in there. That's the code, just like 401k, 401h. So there is a lot of literature and information on it that's out there, but not every actuary does this, knows how.
Yeah,
Um,
I was gonna
all
say
the
maybe I just described worst case scenario of an actuary, right? Because when when we first met, I was using a TPA that like essentially went out of business. And so the client's records and tracking everything they were doing like went completely out the door, right? So it kind of stresses like the importance of using a good one, right?
Yeah, so let me use that for that case, for example, something like that happens. That stuff is still all in the records, and how it was kept is always an evaluation that gets produced every year. So you could take that last valuation and that can be put on a new design,
Mhm.
but it's got to be another actuary slash TPA that understands, does, and gets the
Sure.
401h, right?
Yeah,
And
for
that's not
sure.
everybody. That's just not everybody that's out there. It
Most
is
don't.
a handful. Most
Yeah,
do, yeah,
most
most do not.
don't. So it is a special kind of plan. Now, is it super expensive to set up and maintain?
It's not at all. It's very similar to just like any other plan that's out there. One of the questions that we get a lot is, well, if I have a plan, can I just go add that on it? The answer is yes, you can add it on it, but the design and the TPA do have to change
Mhm.
because it's got to be someone that understands and is doing the calculations that specific way. So,
Sure.
if you have a 401k, for example, you can't add to this to a defined contribution, so it can't be added to 401. It cannot be added to profit sharing, but you we always look at 401ks and profit sharing and say, if we don't have to touch them, if we can leave them alone, let's leave them alone and work everything around it. So generally the plans we get, somebody's maxing a 401, it's not enough because they're in a higher bracket and they have bigger profits they want to put away, and that's where we go and we look at certain designs. And if this is going to get somebody a larger efficiency, meaning more money to the owners, less to employees, and a higher contribution, then it's beneficial. To answer your question from a fee standpoint, it's very similar to, sometimes the same as regular defined benefit, cash balance. Those costs are all over the map based on designs.
Sure.
You get, sometimes higher cost is going to give more to an owner in contribution because
Mm.
those plans, when we talk pensions, they're written for interpretation, and then every actuary has different designs. So where we come in is we simplify all this. We make it all easy. We want to know the goals. We want to know flexibility that the company needs. We want to know what cash flow looks like. And then we just work backwards and go to market to see 4 or 5 different designs and then evaluate and then come up with some very simple solution that sometimes we'll have that 401h option, sometimes might not.
Okay, cool. So for an accountant or advisor that's listening and they're like, "Oh, I want to start looking at this for one client or maybe several clients next week." What are the first steps that they should take?
Yeah, just an email, contact us, or possibly a proposal request, which is a like an intake form, which can be done in our intake form is so simple. It's like 2 minutes, if that. And we generally get those submitted by the tax advisor, CPA, those come in. But we're happy to schedule a meeting with anyone on my team and go through someone's situation, see what they have. The good thing is with these pension plans is we can still take deductions now and into next year and take those deductions for 2025. And the funding does not need to occur if they're on extension next year until next September.
Yeah,
So
the extended deadline. I forgot about that. So a few years ago, they made the ability to contribute to these things a lot more flexible and more retroactive, right?
yes, the one thing that we are pushing right now though is W-2s on corporations matter and income matters
Yes.
on what you can put in these plans. So as we get closer to the end of the year, which we're pretty much there, we do want to have as many of those conversations as possible. So we're coordinating to help advise on, do you need to increase that W-2 based on where you need to get to, where you want to get to in the pension plan. It does have to correspond in some way with what that contribution is. So it's
Yeah.
good. And we don't want to do that after,
No, no, no,
this
no,
year.
no. I still have one one IRS notice from a client 5+ years ago at my old firm that we messed around with their final bonus, and Intuit assured us that they would get the deposit in, and it turned into an $8,000 penalty on that client. So you do not want to mess with payroll with the IRS. I guarantee y'all that, even though the government is apparently coming back around today. Okay, what's something about 401h's that even experienced planners tend to misunderstand?
The distribution probably, like how this money comes out, what happens when it closes. There is complexity around that. We've
Okay.
been through a bunch of plans that have closed before. There's there's quite a few options that are there, and sometimes that makes people confused. I always say it's a good thing because you want options rather than being stuck in one way, one response.
Mm-hmm.
Um, we get ahead of plans closing at least sometimes a year before. And they often close for good reason. Generally, someone's gonna sell a business. They finally got, a great deal, they're out, or they're selling to a partner, or they're buying a competitor and it's gonna change the structure. There's so many different reasons why a plan might close at some point. And we've been through that a bunch of times. So it's probably that end of it rather than just going forward and having. We
Yeah.
have them in certain plans with clients that they don't even care. They don't care that it's there, or they're not even interested in how powerful that benefit is. But
Yeah.
they are generally getting a higher efficiency,
Mhm.
and they're going to wind up with more money, and they can put more money away in their retirement plan than a different design if they have it.
Yeah, for sure. I mean, the most valuable tax strategies are usually the ones that professionals assume are too complex until they actually just learn them and they realize it's not that bad. But you do need someone that is an expert like you that's constantly following the changes in the regulations. All right, we got to wrap up. So we're going to do some rapid fire. You ready?
Yep. Let's go.
Okay. What is one misconception you wish every advisor would stop repeating?
Hmm. I don't know. Repeat. Give me an
I
example.
stumped you on
What's
the
yours?
first one.
Yeah, what's yours?
All right, we're moving on. What's the most overlooked benefit? Pre-tax benefit. I kind of led you with that one. Probably it's the 401h,
Well,
probably.
yeah,
Okay.
I would say retirement plans in general.
Yeah.
I would say in general, I would say, I mean, there's so many people that are not even using we got a case the other day we were looking at where it's like millions and millions of dollars and there's not even a 401k.
Wow.
Like,
Okay.
why wasn't that even started ever or even looked at or had a conversation around? Um,
Yeah.
I
It's
mean,
crazy.
from a tax standpoint, I mean, I'm not the expert in that, but you could say maybe it's uh corp, maybe converting to an S corp or something.
Maybe. Yeah, that's true.
How
Okay.
many people do you see that you're like, wait a second, they shouldn't be in this structure?
Oh,
They're
for sure.
losing.
Yeah. That's actually my next question is like, what's a red flag that tells you a client's not ready for advanced strategies? Because when you, S Corps are a really great example of that. It's a super like low hanging fruit baseline thing. But like everyone and their dog ran to get an S corp over the last decade, and it's not for everybody. And what you learn the hard way is that some clients cannot handle even just the basics of you need to pay yourself in an S corp,
Yes.
right? And so if they're not responsive to you as an advisor, if they're not willing to invest in you being that concierge level of help, they're gonna be a bad client when it comes to even just filing a separate freaking business tax return, right? So, where do you see that like red flags around when you're suggesting defined benefit plan or 401h for clients?
It's it would have to do with cash flow. Like
Mm,
when somebody's talking about, we always recommend 100 to $150,000 should be your contribution minimum, right? And we get a lot of cases and inquiries about, okay, can we start this at $100,000? And then what do you want to put in year two? What's your plan? What's your target? Oh, like $120,000 or $100,000. It winds up becoming too low, too costly. There's not enough revenue that's there. There's not enough business that's there. So I think 150 is really the starting point. And while we explain that there is flexibility, and that's a wonderful thing, these strategies are meant for higher contribution, and that's
yeah.
why I moved that bar up to 150 is really the number that you should start at.
Okay. No,
Look,
that's
we
great.
have quite a few plans right now where we're looking at a million, 1.5, 1.7 annual contributions.
Wow. That's amazing. And that's all tax deductible, folks. That's really crazy. Okay, cool. Is that stacking? Like, is that pre-stacking like 3 years? Because I know you can do that.
We're generally stacking two into one,
Okay,
but going in, or bringing benefits forward to do that, or stacking the plan years, but that doesn't mean they don't get the deduction in year two. It just means if you're putting away $1 million in year one, you might only be able to put away 600 to 700 in year two, three, four, and five.
got it.
Like,
Yeah, that's
yeah,
amazing.
it's
I love it.
not bringing you down to zero every year or small number.
Sure. Yeah. Very cool. Okay, well, we'll have to end on that cliffhanger because I could just keep I could keep going all day with this stuff. It's so interesting to me. David, thank you so much for being with us yet again.
I actually have for an ending. I do have another book for you that I
Oh,
just finished
great!
that I
Yes.
love, and I know last time we talked about a few different books. We talked Ben Hardy and some other stuff. 38 Letters to Rockefeller. The
Ah,
unknown book. Um, I found out about it. I heard about it years ago, and then it was brought up again. I loved it. It's these letters that Rockefeller wrote his son about life, um, philanthropy, money, treating people, and it's like 38 letters, and it is amazing. So,
very
you
cool.
know,
Okay.
and
Yes, I will have to check that out for
I'm not an
sure.
affiliate. I get nothing from
No
this,
royalties for you.
but I know you love that stuff, and hopefully that shares some wisdom with everybody.
I do. Thank you. Yeah, I appreciate that. All right, everybody. Well, have a wonderful rest of your day. Will you go ahead and spell out your website just in case someone's driving and they want to reach out?
www businessbenefitsconsultants.com.
Beautiful. All right. Thanks again, David. Thanks, everyone. Take care.
All right.
Bye.
Thanks, Jackie. Take care.
I appreciate you listening all the way to the end. It truly means a lot. As a thank you, I'd love to give you a free gift, my value pricing calculator and proposal workbook. This tool has helped tax advisors create 8-figure tax plans and save over $1 billion for their clients. You can now download it at taxplaniq.com/ROI-method. Thank you for being part of this journey, and I'll see you next time on the Concierge CPA podcast. Take care, y'all. Thank you for listening to the Concierge CPA, hosted by TaxPlanIQ. We believe that every person has a unique message that can positively impact the world. If you are a successful accounting firm owner or influencer who would like to be on this program, please visit JackieMeyerCPA.com, JackieMeyerCPA.com to apply. Please share this on social media and rate us so we can continue our good work. Join our Facebook group called Accounting Firm Influencers, or connect with me on most platforms under Jackie Meyer CPA. Thanks for being accountable to transforming our industry today.